Good morning. This is Kim Folsom, founder, chairperson, and CEO of Founders First Capital Partners. I'm delighted to be with you and present this webinar on the funding the future and a monetary outlook. And I want to first begin by thanking our partners at Vistage so that everyone and welcome all of the Vistage members who are participating as well. Let me start the presentation by sharing a little background about me. My name is Kim Folsom. I'm a founder, chairperson, and CEO of Founders First Capital Partners and the founder of our accelerator, Founders First CDC. And I also want to share with you, I have been a 10-year Vistage member and know the value that that organization gives to entrepreneurs seeking to want to grow high-performing companies. It's such a great platform and resource to help high-performing companies with growth. A bit about my entrepreneurial background. I consider myself a serial tech entrepreneur and specifically have run a variety of venture-backed companies. I founded 6 tech companies and successfully exited 3. I call the other 2 much more of a learning experience. I've also run four of the 7 companies. You know, prior to Founders First, I had founded 6 tech companies, and across the 7 companies, 4 of them have been certified businesses. And through that experience, I was able to create over 500 premium wage jobs. And this is prior to Founders First, raised over 30 million in venture capital. So I feel like I have an interesting playbook to help other CEOs navigate the interesting experience of having to raise money. When I add my experience with my prior 6 tech companies and Founders First, I've raised over 200 million in institutional capital, and you can see my other background is from education and experience. So I've been at this for over 30 years, and I'm delighted to share some insights of what I've learned through that journey. So with that, I want to take this opportunity to see who's in the audience with regards to how your companies, if you can share, have you used certification in your companies? There's going to be a poll that's going to come up that's going to ask about your use of business certification. And while that's going, I want to go through and share. You may ask, well, what does that mean? You know, it can be certified woman-owned business, veteran-owned business. There's federal certifications, there's small business certification, but would be interested in knowing your experience with that. And we'll give maybe another minute with regards to that and see what do we have in the audience related to that. All right. We have that, and you can see that the vast majority of companies have not been certified, and we've got 31% are certified, and almost 70% are not. I just want to share that you can use those methods. They can be a way of building more relationships because business is so much about relationships. So take that as a consideration to see what certifications your business may be able to take advantage of. So let's get into the topic of the conversation about funding your future and also some practices that other people use to how they do it. The key things with regards to funding and the way you've got to look at it is funding is the fuel that helps businesses grow. The vast majority of people use funding, or capital is another way it's called, over 65% of these people fund their business with their own personal savings, 401k, and that type. And then the next largest group is a bank loan from a financial institution, but that's, less than 70%. But as you can see, the various sources, most people either use that's almost 20%. Others don't know or didn't feel they needed it. And then the others are just various forms of credit cards, personal, friends and family, home equity line, business credit cards, business loans, so on and so forth. But those companies that do master and figure out what is the relevant capital that can help me grow, that can be a game changer with regards to putting you on the path of explosive growth. And so that's what we're going to talk a bit about during our conversation today. So, excuse me, when you think about fundraising, up to probably about, I would say, 10 years ago, there were primarily three ways that people raised money to grow their business. And just as you saw on the chart before, the three primary ways that was done is either by angel financing, which is, high net worth individuals that will write a check because mostly they believe in the founder or the owner, not necessarily because they're, involved in the business. And with that angel financing, you're selling a piece of the business. The other method that's been used is been bank financing, which, they generally, business owners go to their financial institutions that they already have relationships with, and then they take a loan and they pledge their house associated with that. Now, the challenge with this is if you don't happen to have real estate collateral or sufficient collateral, or having a strong financial profile, that can make it difficult for you to be able to get access to that. And then the other form of capital, which has only been available to very significantly high growth companies, is institutional financing. And this is venture capital from, major venture firms that are generally located in two places, either Silicon Valley or New York. But the expectation is you need to have a sizable business, a path of $1 billion or more, and that you can be able to, provide some liquidity event or exit so that, these, significant institutional investors are getting their money back. Fundraising can take a long time, and, it can be a way for you to, provide resources, capital resources to grow your business to the next level. And so, this has been the traditional method. And now we're going to talk about, in the last 5 to 10 years, those three methods that you saw there have grossly expanded. There are now, the conundrum, if you will, the types and resources available to business owners have widely expanded. One is grants. These are non-dilutive capital sources that you can apply for. There's generally very targeted business characteristics that it's available to, but there are many, many grants that are available for businesses that you can take. Generally, they can go as large as millions of dollars, especially if you're an innovative technology or life science company, or some are micro grants that can range anywhere from as small as $500 to maybe $10,000. But those are sources for providing funding. The other is, as I talked about, bank loans. The other thing you need to take into consider with this, you need to have good credit, collateral, and be a profitable operation. Another one since the internet has really kind of been booming is fintech lenders. These are generally fast, merchant related financing that generally are transactional based. It's generally very costly, but it's very fast to get access to cash, and it can cost you anywhere from 50 to 300+%. But that's a way that companies are using cash to fund their operations. Another one is revenue-based financing, which will just in full disclosure, this is the area that Founders First has a level of expertise. And this is more of a shared success capital in that either if you have predictable or repeating revenue streams, this can be a way of getting access to capital that's also non-dilutive and not requiring pledging your collateral to get access to it. Again, angel investors that are helpful for initial startup of high growth businesses that you're going to sell a percentage of the company. Another source that's been available has been crowdfunding, and this works well for consumer products. And generally, you're sourcing capital from publics or networks of folks. In exchange, either they get a special version of your product, you may also sell a portion of your company, but there's a variety of crowdfunding sources that came about as part of post the Great Recession that is providing capital to companies. And then again, for large VCs, again, this works well for core, innovative technology companies, life science, and along with this spectrum, the cost of capital varies as well, and the expectations. But these, 7 options are what founders that are in the know are using to be able to fund the growth of their business. And let's see, with this one, I am going to, I got one more slide I'm going to ask a question about. And this has to do with alternative capital. And I mentioned that, this is an area of expertise that Founders First specializes in. It's a hybrid between debt and equity. And this is a way, if you ever watch the show Shark Tank, the bald guy in the middle, Mr. Wonderful, uses this methodology to fund businesses all the time. And basically, instead of, pledging, your house or, selling like you are traditionally do with traditional debt, or selling a portion of your business like you do many times with equity, you're actually being able to share an investment based on the strength of the revenue streams of the business. And with the strength of the revenue streams, you're really looking at the business from a standpoint of, based on those strength of those revenue streams, you're really being able to get access to growth capital. Many times it's 6 to 7 figures of growth capital, and that you pay it back to agreed upon cap. And that cap is generally a multiple of the initial investment. Think of if it was a 1.5 cap, an initial investment may be in the form of $100,000 or $1 million, for example. And then the repayment cap, if it was 1.5, would be 150 or $1.5 million, and it's over some negotiated period, which could be 3-5 years in term and length. And how the repayment happens is based on revenue share of a royalty, again, negotiated. And let's say that is 5%. And just for easy math, let's say that your average monthly revenues are $100,000. And if it was a 5%, royalty you pay back, that 5% of your revenues or $5,000 goes against the repayment cap until it's paid back in that agreed upon period. And recognize that especially businesses that are small, you have quite a bit of fluctuations of your revenues. This allows for that fluctuations. In fact, if you see this graph to the right, these are the monthly revenue streams. And if you are doing that revenue share, it allows for that fluctuations to take into the consideration. And, it's thought of like a shared success outcomes because your investors that do this type of investing using this flexible stream, you're aligned because, as your business performed, that's how you pay back the revenue share. On those months that you're doing well, you'll pay back a higher revenue share than the months that you're not. And it also incentivizes the investor to help you increase your revenue such that you both win, because as your revenues increase, the value of your business increase, and the more that you can do with that, and then it also allows for paying that back. The thing with revenue-based financing and this alternative growth capital format, it happens on your repayments on a monthly basis, and you pay it back to that agreed upon cap. After that agreed upon cap is achieved, then that's the exit. It's the structured exit. You're not having to sell any other portions of your company, and you still keep the ownership of your company. There's not any board seats and those types of requirements that are in place that happen more often with equity type of arrangements. And so at this point, I want to pause and ask a couple of poll questions. First of all, how you've done with regards to using capital with regards to your business. So there's another polling question: how have you used it to grow your business? Yes or no, if you can share that. And I'll give a few minutes to allow everyone to answer that question. Okay, and this is great input. We've got 13% of people that have said they've used outside money to support their business, and then we've got 41% that said they've not used outside money, and one that said they didn't want to disclose. But if you could think of the chart that I shared at the beginning, those comments are right in line with what was before. In fact, the 64% of people, use their own personal savings to with their business. So that's really good to know. So continuing on with the information I wanted to share, just with regards to thinking about alternative capital as a tool for you to consider with regards to funding your business. When you think about VCs, you've got to think that, for entrepreneurs, which, all of you are on, that, when you exit using venture capital to grow your business, the expectation is that you will have to, have a liquidity event to pay back those investors. And generally, there's other requirements such that the investors, they're expecting a return of something in the neighborhood of anywhere from 25% to multiples, and it can even be 100 times return on their investment. And that can be different than compared to a alternative or revenue-based financing, such that it's a structured exit. You negotiate the terms, be it the cap, the royalty stream, and the duration. And once you've paid back that structured exit, that's it. There's not any further ownership. There's no board seats and those types of things with regards to control. When you think about the return for investors, for VCs, if there's not that big exit, then there's not a return for them. And, less than 1% of companies get access to, less than 1% of companies overall get access to that type of capital. And then for those that provide that big, be it 25% to, 100x returns, it's very, very few and far between, get that type of home run. So it's very inconsistent for VCs. And comparison that to revenue-based financing, which it's much more of a 1.5 to even, there's some deals, like if you listen to how it's done at Shark Tank, it may be a 3x, but it's much more of a consistent return because of the monthly structure exit type of transactions that happen. So it provides for a earlier return to capital for the investor, so it's much more consistent. And then the other factor, just the overall impact from the societal perspective, that VCs are just serving a very small scale of very wealthy group that, it takes, membership access to get part of that group. And then the other side of it is where revenue-based financing this alternative capital options are much more greater and available to people, and there are many more options available. So then when you think about the financial results for the entrepreneur, because you're not having to sell, portions of your company, you have a much more intentional part of it. It provides a not just a source of capital for growing your company, it also provides you a way of building value and your own wealth from the company. And with that, I want to ask the third polling question, if we can share that with our audience, about where people are in their journey to seeking growth capital to grow their business. We'll give a few minutes for people to ask those questions, and then we'll go into our Q&A session. Give a few more minutes for people to respond. All right, and so we've got, based on the respondents, we've got 46 people say they're in market for raising capital, and then 54 are not. So again, well in line with what happens in representative of the overall industry. And with that, that concludes the slides that I wanted to share to give you some background, and then welcome our Vistage colleagues to join, and let's go to our Q&A session.
Hi, Kim. Thank you so much. This is Joe Galvin, everyone. Hi, Chief Research Officer at Vistage. Kim, we had a series of questions that came in that was really informative. You've sure filled my brain with a lot of information, but let's run these questions down. The first one is, what is a maximum capital request for a startup?
So I would say, with regards to the capital, I'm a big believer of crawl, walk, run. And when you think about doing that, it's generally to a point of value creation. So being able to go through and say, when you put together your plan, I may be, having an MVP to prove that that there is acceptance in the market for what I'm doing. And with that acceptance, I need X amount of dollars. I may need 5,000, 10,000, 50,000, 100,000 to prove that I've identified my market. This is what my solution is, and I'm going to identify a sufficient amount of demand to take me to the beta phase of what I'm doing. So my rule of thumb is less than $100,000, preferably less than 10,000, to go through and get either a list of people that says, out of going through this proof of concept, yep, I'm interested in what's being done, and I'm ready to go into the beta phase of what you're doing. And so being able to prove that out, and ideally $10,000 or less, is what I would propose. And just speaking from my own journey, all of my businesses, I've been able to do that with that initial, $25,000, and then going to the beta phase, it's been about 100,000 in the beta phase of what I've done. I know that's a longer answer than what you wanted, but.
Well, no, it was very complete. Thank you. Our next question is, what is the best way to connect with a prospective funder to fund my business growth plan?
So the best one is through a referred introduction. Believe it or not, this is so much about relationships and trust in the business owner. So the best way of having that happen is an introduction by somebody that is trusted by the funder. The best introduction many times is somebody they funded or somebody that they've invested with. That those people are the introduction sources. And most all funders have a trusted advisory group. It may not be called that, but they have a trusted group of advisors that they look for deal flow referral. And when you get introduced to them, there's you get the benefit of that social capital from the person who does that introduction. Then you cold calling or cold emailing them an introduction. And you're going to save yourself so much time doing that.
Like in all things, relationships matter.
So much so.
What's the most important thing I need to have in place to get funded by an investor?
I would say cash flows matter, growth matters. You know, each one of those examples on the kind of that funding options varies, but traction is important. You know, proof that there's demand, proof that you have something that is representative of the value that you propose. You know, as Joe mentioned, that you guys a couple weeks ago had an economic webinar about, you know, the current state of the economy and the planned forecast over the next few years and even longer. People want to see, how are you going to grow to take advantage of the problem that you're solving? If you're trying to build a billion-dollar business, then you need to really be able to demonstrate that, yes, this market is viable. Yes, there's that opportunity. Yes, I can grow to that point. And that you know, validated that demand and the economics associated. The more that you can go through and show that, yes, you have the ability to see that unit economic value with what you're doing, the better. The other thing is realistically understanding your timeline to actually see that capital. People may say, I like you, I like what you're doing, but they want to see, are you doing what you say you're going to do? So it may be, especially if you're going for larger dollars, they may nurture that relationship over a 3, 6, depending on, you know, where you are in your stage. It could be longer. It could take a year or, you know, 2 years before that happens. And some of the other less high growth stage options, it may be a shorter period of time, but then they're going to really look more about what you've done already, even more so, like you're profitable and that you meet specific quantitative metrics with regards to cash flow, margins, and all of those things to help you being able to demonstrate that you meet their criteria for getting access to that capital.
Well, as a follow-on to that, we're kind of in uncertain economic conditions. We're coming out of the craziness of the pandemic era. The economy is kind of moving sideways, but from a slow pace. Is timing really important? Or if you've got a great idea, you need to take your idea while it's hot?
Timing is always important. And, you know, the way that you got a deal funded, you know, pre-pandemic, in the pandemic, and now is different. You know, people are cautious in when the economy's slowing. They want, you know, they are more conservative. And so they're looking for more greater certainty and proof points that you can do what you said you're going to do. So cash flows matter, profitability matters. You know, one of the distinctions between, you know, institutionally funded companies that generally have cash reserves of, you know, 6, 12, 18, 24 months versus small businesses, they generally have less than 6 months of cash. You know, those things matter as well. So when you think about the initiatives that you're going to pursue, really being able to pursue those that you believe are going to provide a return on investment. Now, it may be that this is the great opportunity for you to pivot and introduce more profitable things or cutbacks on things, but doing that analysis, like one of the things that's happened in the last, I would say, few years with regards to venture financing and looking at raising money is investors are asking not just for your plan, they want to see scenario and sensitivity analysis. They want to see, this is what you're proposing to do and what are the upside and downside risks and what are you thinking about related to that, and even what to get you where you have been, what have you learned? What did you do last year that you're gonna invest or double up on? And what did you do last year that you're not gonna do?
Well, earlier you had said start small, right? $25,000 or less, then in round B, go bigger. This question takes the big swing. It says, what is the process to raise $1 million plus?
Yeah, it is going through and showing, well, the one thing when you think about raising $1 million, recognize who can you get that $1 million for. Generally, that's larger investors. And so you got to think about, it's just like selling your products and services. You've got to find out what are the requirements of that buyer, because you're selling your business to get access to $1 million to be able to get that back. So you've got to be able to recognize, in order to get that $1 million, that investor is expecting a certain return on investment. They're expecting a return horizon for that investment. And when you make that ask, you've got to prove that. So you've got to say, if I'm looking for an investment of $1 million, I'm going to return back, 3x, 5x, 10x, 25x or more if you're going to an institutional venture, and I'm going to return it in this period of time. And that's really what you've got to be able to share with regards to your ask. And then not just that, because I've seen so many, deals where people say it's more spreadsheet gymnastics. I'm trying to raise $10 million and I'm going to build a company that's 100 million, because if you do the math, that's 10x, right? But there's no backup to even give any credibility that they can do it. So how are you going to go from where you are today to get to build that $100 million business to give them that 10x return? And the other thing is, the most common, this is the different distinction between, institutional equity versus, alternative capital, because you can raise $1 million in both those channels. You've got to take into consideration, how are you going to give that liquidity event to happen? So let's say your business is at $1 million and you say you're going to get to 10 million. So you're going to 10x the value, but how are you going to honestly give them back $1 million? Many times people say, oh, the way I'm going to get it paid back is I'm going to get acquired. You've got to go in when you ask the question, how is the liquidity event going to happen? And if you got to really in your heart be comfortable and can speak eloquently, the liquidity event that's going to give them back their exit. If they're expecting 25% return, 2x return, 5x return, how are you going to do it? If it's going to be equity, then it may be, I expect to be acquired in 3 years, 5 years, and who's going to acquire me, and what, based on other similar types of acquisitions, the valuation that occurred, so that you give them the comfort that you have a plan to give them their money back, to return their investment. If you cannot do that, you will not be able to raise that amount of money.
Okay, great. I'm really looking forward to your answer to this next question. What should I do if my prospective investor wants me to step down as CEO in order to raise funds?
You know what? You've got to be able to decide, is that what you want? You have a choice. You have the power. You can go through and say, this is something I'm ready to do. If you think that the next phase of where you're wanting to grow the business, that either you're going to build the team to help you get there, or you're going to, build the team to help you get there in some way, then maybe that's not what you want to do. And maybe you want to find other investors to do this. I mean, just know that you have the choice to do that. And you have to pick the investor that you have shared values and a shared vision of what's the best way of doing it. Your best time get your relationship with your investor is before you take their money. You need to make certain you're at the same, on the same page. Now, that doesn't mean that you're always going to agree on how to do things, but you've got to talk through what's the next steps and understand. I mean, the best situation is to have these discussions around okay, you're proposing for me to get your money that I step down as CEO and we hire another one. So let's say that you're ready for that transition. I've met founders that way too. Sometimes they feel like, you know what, I'm doing something to the next phase of where I need to be that I don't know, and I'm not comfortable, or because of other life, choices that I'm making, I'm ready to hire somebody else. But then if that's where you're comfortable with, then you jointly decide, well, if it's not me, what is the characteristics and qualifications of the person that it will be, and that you're part of that discussion, not just that you're selling your company, you're giving it away, and that you're part of it. So it may be that you either stay on the board or you're, some role in the next phase of this. But, you have options. One is finding other investors, or if you do that, that you're part of the journey. But, you have a choice.
Thank you. Here's one. What resources are available to women and minority-led microcap small and mid-sized businesses?
Oh, there are, a number of accelerators, funders that do have a focus on funding a lot of different specialty areas, some by industry, some by specific, you know, uh, social demographics. And so, if you were, the great part about, where we are in the last 30 years is you can Google anything and find out, who are the investors that focus on investing in women, what accelerators are available to invest in women businesses, what type of grants are available to invest in women-led businesses, what type of banks, and I mean, so you can be able to carve out those. And then the other is there's other institutions too. Educational institutions are another source that can, direct you to those. But that would be a great way of doing it. And just in all disclosure, Founders First, we do have made a priority, not exclusive, but we made a priority to working with diverse-led businesses, not just by gender or not just by race, but by geographic and other socioeconomic characteristics.
Sounds like my first call might be to you. Next question. Is revenue-based financing an option with all collateral being pledged to a small business administration loan?
Yes, it is. Most revenue-based financing lenders, not all, will either work with a business that is taken SBA collateralized loan. And it's because if you pass the rigor of getting a traditional bank financing loan, then you're a pretty good credit risk as part of an alternative or revenue-based financing. So they generally will either be pari passu, or they may be subordinate to the SBA loan.
Okay,
But provided, I was going to say, just provided that you can demonstrate that you have sufficient cash flow and profitability in your business, meaning gross margin, that you can service that additional, repayment, then you can definitely have that happen.
Okay. So staying in the revenue-based financing lane, is revenue-based financing a realistic opportunity for startups that have yet to generate revenues?
No, it's not. I mean, because it's based on revenues and it's based on, the history of those. So it's very much based on revenues, one. But there are still shared success capital options than revenue-based financing. Example, another one can be profit sharing, meaning it could be a delayed structured exit. Like it could be one of those that, hey, for the first, year or so, or 6 months to a year until you start generating cash flows. And then once you do, there could be a delayed rev share, or it could be a delayed profit share. I've seen those models in place.
Okay. So what happens if the business fails before revenue-based financing is paid off?
Then it may be considered a a claim against the assets, and if the assets are sold, then some of it may be used to repay that that type of thing.
Right. How does revenue sharing work? In other words, do investors have access to financial statements?
Yes, yes. I mean, they always have access to that. They have access to, I mean, this whole perception, yes, you share, that's part of the relationship and the risk sharing, that you need to provide your financial statements monthly, and you generally need to provide access to your accounting systems to make certain that everything's on the up and up with regards to how you're keeping track of revenue and expenses and access. And it's generally just inquiry level access to that and banking information, just so that the proper calculation of the payment is made, and the allocation of the royalty is made.
Okay. A couple more. How do you value your company? What's the best valuation model? How do you see the IPO of a startup? That's like one question with 27 parts, but go ahead.
Okay. So you don't have to do the valuation independently. Most folks are, the value is set by the investor, but you can go through and say, just to use that analogy, if you watch Shark Tank, generally the entrepreneur says, I'm trying to raise X dollars and I value the company at Y, and I'm gonna sell Z amount of my company to do that. This is an equity situation. That happens in an IPO. They're going through and saying, I am seeking to raise, pick a number, $100 million, and I'm going to sell, 30% of the company to do that. And so if you take that and look at the overall shares of the company, it comes out to be a per share price. And, that's what you come to the table with. And you should have done your homework about what similar types of pricing based on the performance of the company, from revenue, track record, any type of IP and so forth, that I'm coming to value the company, and then the growth trajectory going forward. And then the investor will go back, because the person that you want to do business with is somebody who has invested in similar businesses like yours, that has said, well, either I will take your valuation, which generally doesn't happen. They generally will negotiate back with, well, you're saying you want a share price of X, $15. I think you're worth 12 or 10 or 13, but they're generally giving you some rationale through that. Or if they completely think you're off the mark, it will be, this is just not a fit for us. And so there are professionals that can help you with that valuation. In an IPO situation, investment bankers work with companies to help them with all of that stuff, to help you with putting your, all of getting the company ready for that and pricing your business. And then they generally have a relationship of, hundreds, thousands of investors that will invest in deals like yours.
Great. Do funders fund service-based businesses?
So I would say that some do. Some have there are categories of funders that do fund service-based businesses. I will say, though, that so many people are in love with the idea of VCs. Most VCs do not fund service-based businesses because there's not any tangible IP associated with that.
Well, Kim, that completes our questions. I want to thank you so much for sharing your insights with our community, your experience, not just as an entrepreneur, but your obvious in-depth knowledge of how this all fits together and how to help entrepreneurs get going is really appreciated. it. So thank you very much. I believe this will help a lot of entrepreneurs listening in take their companies to the next level.
Well,
For
thank you.
Go
Thank you
ahead.
for the
I'm sorry.
opportunity. It was delightful to, share these insights, and, I have such fun, appreciation for Vistage and all the things that they do for entrepreneurs. It's just a great platform.
Thank you for that. We appreciate that. To our listeners, we'll be sending a link to today's recording and slides within 24 hours. Also, please be sure to join us for our upcoming webinars. On August 25th, don't miss our Vistage exclusive session with best-selling author and organizational psychologist Adam Grant, who shares how rethinking can help leaders and organizations. Vistage members can register on My Vistage. Upcoming webinars available to everyone include August 4th, Managing Workforce Velocity, Improving Employee Retention. September 1, Exploring Asset Protection Strategies Amidst Financial Market Volatility. September 8, De-Weaponized Accounting for High-Performing Teams. And September 22, Future-Proof Talent. What matters to tomorrow's workforce matters today. I'm Joe Galvin, your Chief Research Officer, and I thank you for attending. We look forward to seeing you at our next event.